We're here today to talk about our new book, Conceptual Foundations of Investing. And you might think that you don't really need to talk about the conceptual foundations. Isn't there a gold standard for evaluating investments? Look at the track record. The answer is no, track records really aren't very helpful. But to understand why we need to take a step back and maybe talk about a little history. Science is often affected by surprising empirical findings. One of the most famous, we're here at Caltech in Pasadena, was the discovery by Edwin Hubble that the universe wasn't static but was in fact expanding. And that led to a revolution in cosmology that's still ongoing today. Now there's nothing quite that dramatic in finance, but there is a similar experience. And it dates back to 1963. In that year, Merrill Lynch gave to the University of Chicago a financial grant to open a new center called the Center for Research in Securities Prices. And in addition, Merrill Lynch provided the center with daily data on trading in basically every listed U.S. stock from 1926 through 1963. And the center, often called CRISP, for CRSP, took this data, cleaned it up, made sure that it was accurate, put it onto computer tapes, and for the first time, scholars had the ability to study daily stock price movements over long periods of time in an electronic environment. And at that time at the University of Chicago, there was a young professor, just joined the faculty, and his name was Gene Fama. And this is a picture of Gene. This is a recent picture. In 1964, he had a lot of hair, and in fact, he'd been a Division II football running back, a very vigorous, athletic guy. This is a picture about the time that he received the Nobel Prize in 2014. But Professor Fama was one of the first to really use the CRISP data to study the behavior of stock prices, including track records. And he reached a conclusion. He was asked, what can one learn from 1, 3, or even 5 years of past returns about a manager's skill or the future performance of an investment? Now, 5 years, that's pretty rare. When the financial press reports track records, you rarely see anything beyond 3 years. And Professor Fama's answer was, the short answer, usually almost nothing. Professor Fama found that track records, even up to 5 years, and certainly for 3 years, had virtually no predictive power whatsoever. Now you might say, how could that be true? Well, let me give you an example of the problem that Professor Fama found. I have here a dice. And suppose I wanted to know the probability of rolling a 6. Well, you might say that's 1/6, but you're cheating. That's if the dice is fair and balanced and all. Maybe this dice has been engineered so that 6 never comes up. So if I wanted to determine the probability of rolling a 6, one way to do it would just be roll the dice again and again, count the fraction of 6s. So I start. I roll the dice once, and I get a 4. So I conclude in my experiment I didn't get any 6s, so the probability of getting a 6 is 0. Now you might say, whoa, that's not reasonable. You only rolled it once. How much information could you get? And that is exactly Professor Fama's point. Looking at track records of 1, 2, or 3 years is akin to rolling the dice once. You just don't get enough information to be able to draw reliable conclusions about performance. Now, to see that in the context of the market, let's look at some actual data. And Professor Fama asked the question, does the stock market outperform Treasury bills? Now, you might say, of course. Look at the history. Well, the slide that you can see shows that if you'd put $1 in the stock market in 1926, by 2017, you'd have over $5,500. If you put the same dollar into Treasury bills, by 2017, you'd have only $20. So clearly looks like stocks outperform treasury bills. And Professor Fama would agree. That's true. But he says in order to reliably reach that conclusion, you need on the order of 40 to 50 years of data. Why so much? Here's a hint. The red line shows the annual returns from investing in treasury bills. They're always positive, they're relatively low. The blue line shows the annual returns from investing in the stock market. They're all over the place, dramatically up and down, varying from year to year. It is this volatility of the stock market which makes it so hard to reach reliable conclusions about whether one investment has done better than another. Now, you might say, well, we know there got to be some investors who've done better than the market. And here's probably the most famous example, Warren Buffett. Starting in 1965, he's grown Berkshire Hathaway, the vehicle through which he invests, into a multi-hundred-billion-dollar company, and his own personal wealth is nearly $100 billion. So surely he's done better than the market. Well, let's take a look. But before we do that, I want to talk about one more statistical problem. Now remember the dice. Suppose that rather than rolling this red dice once, I rolled it hundreds of times. And based on that, I found that I got a 6 about 1/6 of the time. So I'd conclude that the probability of getting a 6 was 1/6. And that's true as long as I keep rolling the red dice. But nature doesn't allow you to be sure that that's what happens. What if after rolling the red dice for a year, she substituted this green dice? Well, then the notion that the probability was 1/6 based on the red dice would be out the door. Statisticians have a name for this problem, and it's called non-stationarity. It means that the world from which I evaluated something and the world that currently exists are different. Now, how does that relate to Mr. Buffett and his investments? Well, over time, things change. Investors get older. They hire new people. Markets change. And perhaps most importantly, if they're successful, they get increasing amounts of funds under management. And all those things can lead to differing performance. So let's look at how Mr. Buffett has actually done relative to his preferred benchmark, which is the S&P 500. And the current slide shows you the data on a decade-by-decade basis. And during the first 3 decades, Mr. Buffett slaughtered the market. He exceeded the S&P 500 by double digits in all the first 3 decades and beat it by nearly 30 percentage points in the decade of 1975 to 1984. But more recently, as Berkshire has grown, his performance relative to the market has changed. In the decade of 1995 to 2004, he only beat the S&P by 3.59%. And in the most recent decade, beginning in 2008, he's actually underperformed the S&P 500. Evidence of potential non-stationarity. So is Mr. Buffett still a superior investor? It's uncertain. So that's our first conceptual foundation. Track records, particularly track records of 1, 2, or 3 years, are virtually no use in evaluating investors or investments. The second conceptual foundation relates to the work of William F. Sharpe, shown on the screen. Professor Sharpe was one of the first financial economists to win the Nobel Prize for his work on the capital asset pricing model. And he's made numerous contributions to finance. One of the simplest, but most important, is something that's come to be called Sharpe's arithmetic. And the best way to explain it is with a simple example. Now, I want to stress one thing. Sharpe's arithmetic doesn't depend on anything about the market other than the rules of arithmetic. Doesn't require the market to be rational. Investors can be fearful, they can be emotional, there can be insider trading, there can be market manipulation. All those things could be going on, and yet Sharpe's arithmetic still holds. Now, to see how it works, let's just use a specific example. Suppose that in a particular year, the overall market was up 10%, and the overall market is shown by the big circle on the chart. Now divide investors into two groups. Passive investors, who just buy an index fund and hold the market, and active investors who do anything else. So you'd be an active investor if you traded a lot, but you'd also be an active investor if, rather than holding the overall market, you held a relatively smaller portfolio. For example, Mr. Buffett, who holds usually no more than 50 stocks, is an active investor because his portfolio in no way matches the market. So now, in this year where the market went up 10%, the passive investors who are holding the market portfolio, by definition, must have earned 10%. So now we know the whole market is up 10%. The red part is up 10%. By the rules of arithmetic, the blue part, the active investors, the rest of the market, must be up 10% before fees and expenses. But active investing is expensive. You have to hire PhDs and build exotic computer networks and spend a lot of time crunching numbers. All that costs money. So on an after expenses basis, Professor Sharpe's arithmetic shows that active investors will always underperform passive investors as a group. Surprising conclusion, and depending upon nothing but the rules of arithmetic. Well, you might say, wait a minute, there's active investors like Mr. Buffett, who clearly did outperform the market in passive investors. What about them? Well, to the extent that there's one of those, there have to be other active investors who underperform by even more because of the expenses, so that active investors as a group underperform passive investors as a group. So if you decide to be an active investor, you're going to only do better to the extent that you transact with someone who does worse. One example of Sharpe's arithmetic, you can look at the performance of mutual funds. Now, mutual funds aren't all active investors, but they're a big part of it. And if Sharpe's arithmetic is right, you would expect that as a group, mutual funds would underperform the overall market. The slide we're showing here with the red line at 50% indicates that is indeed the case. On average, over extended periods of time, less than half of the mutual funds outperform the market. So, to the extent that you're considering being an active investor, this second conceptual foundation says, think about your counterparties. If you're trading a stock, you're most likely to be trading against a big active counterparty. And here are some examples of that. David E. Shaw, he has a hedge fund called D.E. Shaw and Company. Perhaps most famous now for its young employee who was one of their stars, a guy named Jeff Bezos, who told Mr. Shaw he was leaving to start an online bookstore. But Mr. Shaw has become a billionaire many times over. He may be one of your counterparties. Of course, Mr. Buffett, who we've already spoke of, may be one. Another possibility is Jim Simons, world-renowned mathematician who started Renaissance technology and made more than $10 billion for himself actively trading stocks. Third, just one more possible counterparty is Ray Dalio and Bridgewater Associates, perhaps best known to many people for his short book called Principles, but Mr. Dalio's hedge fund, Bridgewater Associates, was the largest hedge fund in the world. So, the second conceptual foundation. If you want to actively trade investments, be aware of Sharpe's arithmetic. Be aware that active investors as a group will always underperform passive investors, that one active investor can do better than the average only if someone else does worse by an even larger amount. Now, the third conceptual foundation we'd like to talk about this afternoon from our book involves how the market prices stocks, and in particular, something that Mr. Buffett has mentioned dozens of times in speeches and letters to investors and so forth, which is he only likes to invest in companies that have moats around their business. And by a moat, he means something that prevents competitors from coming in and competing down the returns that investment in that business can earn. And he got into quite a back and forth with Elon Musk, who seems to be getting into back and forths with just about everybody, regarding these so-called moats that Mr. Buffett talked about. So let's use this moat idea to try to understand how the market prices securities and how you might find a superior investment. So I have a very simple company here called Cornell Software, and there's a $1,000 investment in the company. The key thing is, what is the return on that investment relative to a fair stock market return? So in this example, the return on the investment in the company is 20%. A fair stock market return is 10%, so this sounds like a good investment, but not so fast. It depends on how the market prices the investment. If the market is aware of the moat, if the market realizes that you can make a greater return by investing dollars into this company, the stock price is going to go up and the investor's return is not going to be any higher than the fair return of 10%. Now, the best way to see this is to change the assumption of the return on investment. For example, I've got 20% here. Suppose this company had a big moat so that I raise the return on investment to 50%. Does that make the investor return better? No, it doesn't. All that happens is the stock price jumps up from what is shown now as $2,000 to $5,000. So to the extent that the market understands the moat and prices it, investing in companies with moats is no better than investing in companies without them. And Mr. Buffett really doesn't make that clear. In fact, let's look at some data. The best way to measure the moat is what is the value of the company, the price, compared to the number of dollars invested in the company, the book value. And you can see for the first company on this list that $1,000 invested in Amazon by Mr. Bezos is worth $28,000 in the market. That's because the market sees Amazon as having significant moats. Its technology, its size, its brand name make it very difficult for competitors, and therefore it trades at an extraordinarily high price. That means it's a great company, but it doesn't mean it's a great investment. We'll come back to that in a minute. You can see Apple trades at a price to book of 7.4, also evidence of a moat. But Citigroup trades only at 1.0, Edison at 1.8, and General Motors at 1.6, and finally General Electric at 2.2. The market is saying those companies don't have very good moats. Does that mean they're bad investments? Not necessarily. Depends on how good the moat really is compared to how good the market thinks it is. Finally, you see a couple real outliers. Netflix trades at a price to book ratio of 43. Market seems to think there are huge moats there. Quite frankly, I wonder what those are. And the same is true of Tesla, which trades at a price to book of 11.8 compared to 1.6 for General Motors. It's as if Tesla were making a different product than General Motors. So what does it mean to find a superior investment that might allow you to beat the market? And in fact, there are 3 required steps. The first is you've got to find an investment where you think the fair value differs from the market's valuation. And this will probably be quite rare. For example, at the hedge fund that I run with my sons, we do a valuation of Amazon, comes out around $1,800. If Amazon is trading at $1,800, doesn't make it a good or bad investment. Yes, we recognize it's a great company, but so does the market, and there's no particular benefit from investing in Amazon. You have to find a situation where you think the company is mispriced. In our case, one of the examples of that was Tesla, which we feel is overpriced. So now we've found an example where we disagree with the market. The second step is you have to be right. You might disagree with the market, but the market may know a lot more than you do, in which case you're likely to lose rather than to win. And the third thing that has to happen is that the market has to realize you're right. If we're correct and Tesla is overpriced, we don't make any money off that realization until other participants in the market come to agree and the stock price drops. Now, there's one exception to that third step, that you have to wait until the market agrees with you. And I learned this in a course I taught with a relatively famous gentleman, Michael Milken, or the so-called junk bond king. And Mr. Milken said, well, while that third step may be true of stocks, it's not true of junk bonds. If I find a company that has to pay a very high interest rate on its debt because the market thinks the company is distressed, but I believe that it's a good company and it's going to honor its payments, if I buy those low-grade bonds, I get that high interest payment, whether the market ever comes to agree with me or not. So Mr. Milken felt that for people who felt they could find mispriced companies, buying their junk debt may be a better way to make superior returns than buying their stock. So that's the third conceptual foundation, that you have to not only think about the quality of a company, but about the quality of a company relative to the market's perception of that quality. And it's only where the two disagree that there's a reason for you to become an active investor as opposed to a passive investor. So we hope those three conceptual foundations will be helpful to you in thinking about your own investments and managing your own money. Thank you.